When the world starts whispering about uncertainty, some of the smartest money doesn't wait for headlines, it moves. Billionaires are quietly scooping up gold, not out of panic, but because they see patterns most of us miss. While everyday investors debate market noise, these heavy hitters are positioning themselves for what they know is coming, reading signals that only decades of navigating crisis can teach. In 2026, their moves are sending a clear message: gold isn't just a safe haven, it's a window into the mindset of those who've mastered the game. Rising geopolitical tensions have always been the invisible hand moving markets, but in 2026, the scale and complexity of global unrest are unlike anything we've seen in recent memory. It's not just a single conflict or a lone flashpoint. There's a tangled web of crises unfolding simultaneously, each amplifying the other. And billionaires are reading it like a map, from the escalating energy disputes in Europe to territorial disagreements in the South China Sea, from cyber warfare threats targeting critical infrastructure to sudden shifts in alliances among major economies. The signals are everywhere if you know where to look. Ordinary investors often react to these headlines with anxiety or confusion, but those who have spent decades mastering the flow of capital understand that geopolitical tension isn't merely noise, it's a leading indicator of financial movement. Gold in this environment transforms from a commodity into a strategic lifeboat, an asset whose value rises precisely when uncertainty peaks. The beauty of gold as a hedge lies in its historical consistency. Across centuries, every time governments faltered, currencies wavered, or wars erupted, gold maintained its worth. It doesn't yield dividends or pay interest, yet in times of crisis it becomes the most liquid form of trust the market can offer. In 2026, this principle is magnified. Billionaires are scanning geopolitical developments with surgical precision, analyzing not only the immediate fallout but the ripple effects that could destabilize currencies, disrupt trade, and shake markets. They recognize that gold is one of the few assets whose value is inversely correlated with the unpredictability of human events. When borders are disputed, when sanctions fly, when supply chains are threatened, the metal's worth doesn't just hold, it often accelerates. Take, for instance, the energy conflicts gripping Europe. As nations grapple with energy scarcity and maneuver to secure long-term supplies, the economic consequences are profound. Inflation spikes, currency volatility grows, and businesses facing higher operating costs may falter. Investors who anticipate these dynamics early position themselves to benefit, and gold becomes the go-to instrument. Unlike stocks, which are tethered to specific companies or sectors, or bonds, which can be undermined by interest rate shifts and sovereign risk, gold acts as a universal buffer. It is an asset that transcends borders and governments, immune to the immediate failures of national policies. For billionaires who have built their wealth on timing and foresight, this quality is indispensable. Meanwhile, tensions in the South China Sea highlight a different aspect of geopolitical risk: trade disruption. Shipping lanes that carry a significant portion of global commerce are at risk, and any escalation could have cascading effects on manufacturing, technology supply chains, and international trade agreements. Savvy investors understand that even the threat of conflict can spark flight to security. Gold, in such moments, becomes not only a hedge but also a statement of strategic foresight. It's a way to protect capital against shocks that are difficult to predict but almost certain to occur in a world where competing national interests collide. By quietly accumulating gold in response to these pressures, billionaires signal confidence in their reading of global dynamics and a willingness to act before conventional markets react. Cybersecurity threats add yet another layer of complexity. Nation-state actors and sophisticated hacker groups are increasingly targeting financial systems, creating uncertainty in digital assets and banking infrastructure. While many investors might panic or ignore these risks, the most experienced players see them as part of a broader pattern where tangible, physical assets like gold gain relative security. Unlike digital transactions that can be disrupted or frozen, gold provides a hedge against systemic failures in the digital financial realm. In essence, It's a way to insure against a wide array of risks that no single market instrument can fully cover. For those watching the global chessboard, each cyber attack is another variable reinforcing the value of holding an asset untethered from electronic networks. Political instability in key economies further intensifies the allure of gold. Sudden leadership changes, contested elections, and the rise of populist movements introduce volatility that can ripple across markets in unpredictable ways. Investors with a deep understanding of macroeconomics and political risk recognize that these events often precede currency devaluation or inflationary spikes, conditions under which gold typically outperforms in 26, with several major economies exhibiting these very characteristics. The incentive to increase gold holdings is clear. The metal becomes not merely an investment but a shield, a tangible asset that holds intrinsic worth even when paper wealth fluctuates wildly. Billionaires who are active in this space are not simply buying gold blindly, they are calculating, watching, and interpreting the geopolitical landscape minute by minute. Every announcement of sanctions, every rumor of a trade disruption, every sign of diplomatic tension is a piece of the puzzle. Gold is the constant in this storm, the asset that responds in predictable ways to unpredictable events. By accumulating it strategically, these investors are converting foresight into tangible security. They are effectively transforming the chaos of international conflict into an opportunity for preservation and growth, ensuring that when uncertainty peaks, their wealth remains insulated in a way that paper assets cannot match. Inflation fears are shaping the financial landscape in ways that many casual investors fail to grasp, yet for billionaires, it's a signal impossible to ignore. Across the globe, central banks continue to inject liquidity into economies in an effort to stimulate growth. But the side effects are mounting. When more money chases the same amount of goods, the purchasing power of currency erodes, and what seems like an abstract statistic on a report becomes a tangible threat to wealth. For everyday savers, inflation often creeps up unnoticed, subtly reducing their ability to maintain lifestyle or security. For billionaires, however, it is a call to action, a warning that the safest way to preserve value is to shift in assets that retain intrinsic worth, and gold is the classic refuge. In 2026, with consumer prices surging in multiple economies and core inflation metrics stubbornly high despite interest rate adjustments, gold's appeal is amplified beyond as a safe haven. The mechanics of inflation are deceptively simple, but profoundly impactful. Currency devaluation means that the same amount of money buys less than it did yesterday. In practical terms, portfolios heavily reliant on cash or low-yield bonds become less effective at maintaining real wealth. Billionaires recognize this and move with a speed and decisiveness that ordinary investors cannot match. They see gold not only as a hedge but as an asset that can outperform during periods when traditional financial instruments lose their purchasing power. Unlike fiat currencies, which governments can print at will, gold is finite, tangible, and universally recognized. Its value is anchored not by policy promises but by scarcity and historical trust, the qualities that become invaluable when inflation threatens to erode the nominal value of paper wealth. Recent shifts in global supply chains have added urgency to the gold accumulation strategy. Rising costs for commodities, raw materials, and transportation feed directly into consumer prices, creating inflationary pressure that can ripple through every sector. Billionaires watch these trends closely, analyzing which markets are most vulnerable and which central banks are likely to respond with stimulative measures that could further weaken currency. When you can anticipate a wave of inflation before it fully manifests in mainstream financial markets, buying gold becomes less a defensive move and more a proactive strategy. It's about positioning oneself to weather the storm, but to profit from a precise understanding of monetary dynamics and the way governments respond under pressure. Currency risk also plays a critical role in this calculation. When inflation accelerates, national currencies often looty against foreign reserves and precious metals. Billionaires with international holdings diversify strategically, ensuring that exposure to any single currency does not threaten overall wealth. Gold serves as the perfect instrument for this purpose. It is globally recognized, highly liquid, and universally tradable. Its value is not contingent upon the policies of one nation or the solvency of a single government. This universality gives it an advantage over even the most diversified fiat portfolios, which can still suffer if multiple currencies experience simultaneous inflationary pressure. In this sense, gold becomes a kind of global insurance policy, a tangible safeguard that maintains purchasing power when paper money falters. Historical precedent reinforces this strategy. Looking back at periods of rapid inflation, from the Weimar Republic in the 1920s to Latin American economies in the late 20th century, gold consistently outperformed other assets. Stocks might have delivered gains for select companies, and real estate could have appreciated in certain regions. But the universal security of gold was unmatched. Billionaires in 2026 are acutely aware of these lessons. They study not only domestic inflation data, but global trends, recognizing that interconnected economies mean that inflation is rarely isolated. A surge in commodity prices in one region can ripple across borders, affecting currencies and markets worldwide. By holding gold, these investors hedge against both domestic and international inflationary shocks simultaneously. The psychology of inflation cannot be underestimated either. When people fear that prices are rising faster than their income, behavior changes, spending slows, markets fluctuate, and volatility increases. Billionaires use these behavioral shifts to their advantage, anticipating market reactions before they become widely evident. Gold, in this context, becomes more than a hedge. It is a strategic tool to capitalize on uncertainty. Its demand often rises as ordinary investors recognize the threat, creating upward momentum in price. Those who accumulate early, guided by sophisticated analysis rather than panic, benefit disproportionately, reinforcing the idea that foresight and timing are as critical as the asset itself. Finally, the interplay between inflation and interest rates adds a layer of complexity that only the most experienced investors can navigate. Central banks respond to rising prices by adjusting rates, which can affect debt, equities, and bonds. These moves, while intended to stabilize, often introduce volatility and uncertainty, creating an environment where tangible assets like gold shine. Billionaires, by monitoring inflation indicators, interest rate trends, and monetary policy signals, can anticipate periods of instability and adjust their gold holdings accordingly. They understand that in a world where currency loses value and financial markets react unpredictably, owning a finite, historically trusted asset provides both protection and opportunity, allowing them to stay ahead of the curve while others scramble to catch up. Gold is not just a shield against inflation or geopolitical instability. It is a strategic lever in portfolios designed to withstand the full spectrum of market volatility. Billionaires in 2026 are acutely aware that traditional asset classes, stocks, bonds, real estate, carry risks that can be magnified during turbulent times. Equities, while potentially lucrative, are tied to the performance of individual companies and sectors, making them vulnerable to sudden shifts in consumer demand, regulatory changes, or technological disruption. Bonds, long considered safe, can falter when interest rates rise or when sovereign debt becomes questionable. Real estate, though tangible, is subject to localized economic downturns and liquidity constraints. Against this backdrop, gold's performance appears almost counterintuitive in its simplicity. It does not depend on a company's earnings report, a government's fiscal policy, or consumer sentiment. It derives value from scarcity, historical trust, and universal demand, which makes it uniquely resilient when markets turn volatile. Volatility, in fact, is exactly what makes gold so compelling right now. The 2026 markets are anything but stable. Rapid technological innovation is reshaping industries at unprecedented speed, creating winners and losers in a matter of months. Shifts in energy production from fossil fuels to renewables are upending traditional business models and generating uncertainty in commodity markets. Supply chain vulnerabilities persist, exacerbated by geopolitical conflicts, natural disasters, and protectionist policies. In this environment, stock prices can swing wildly, bond yields can fluctuate, and even sophisticated investors can be caught off guard. Billionaires, however, see these fluctuations not as anomalies but as opportunities to position gold as a stabilizing force. By allocating a portion of their wealth to an asset that thrives on unpredictability, they are essentially insulating themselves from the ripple effects of volatility across other markets. Market psychology amplifies the effect. When investors sense instability, fear can spread faster in facts, triggering sell-offs that cascade through interconnected asset classes. Those who rely solely on equities or bonds often find themselves reacting emotionally, selling at a loss, or making hasty decisions that exacerbate volatility. Billionaires, by contrast, anticipate these behavioral patterns. They know that when panic grips the market, liquidity can dry up, margin calls can force asset sales, and correlations that normally hold may break down. Gold, in this context, functions as both a hedge and a tool of psychological leverage. It is the asset that investors flock to when confidence erodes, and its price often rises precisely when other markets are plunging. The timing of acquisition, therefore, is critical. Buying gold during periods of low visibility or before panic spreads allows for maximum advantage, turning market turbulence into a calculated gain rather than a risk. Another layer to consider is the correlation, or rather, the lack of correlation, between gold and other assets. While many investments move in tandem due to macroeconomic factors, gold often behaves independently. This independence is what makes it a cornerstone in risk management strategies for billionaires. In a diversified portfolio, assets that are poorly correlated provide balance. When stocks falter or bonds lose value, gold can offset losses, smoothing returns and preserving wealth. In 2026, with global markets exhibiting heightened unpredictability, this non-correlation becomes even more valuable. Billionaires are not buying gold because it guarantees a windfall. They are buying it because it guarantees resilience. In an environment where markets can swing violently in a single day, having an asset that reliably retains value is not just prudent, it is essential. Liquidity is another factor often overlooked by casual investors. During extreme market events, the ability to convert assets into cash without significant loss is critical. Stocks may be difficult to sell if the market collapses, real estate transactions can be delayed by weeks or months, and bonds may be subject to discounts or illiquidity. Gold, by contrast, has always been highly liquid. Whether through bullion coins or exchange-traded instruments, it can be converted into cash almost anywhere in the world. Billionaires leverage this liquidity strategically, knowing that in times of sudden crisis, having assets that are both valuable and easily transferable provides tactical flexibility. It allows them to seize opportunities that arise during instability, whether that means acquiring distressed assets, funding acquisitions, or reallocating capital to more advantageous positions. The interplay between market volatility and macroeconomic trends further reinforces gold's role. In 2026, economies are experiencing a confluence of inflationary pressures, policy uncertainty, and technological disruption. Stock indices reflect these tensions with unpredictable swings. Bond yields fluctuate in response to monetary policy shifts, and currencies react to both domestic and international pressures. Billionaires understand that the only constant in this maelstrom is scarcity, which is precisely what gold represents. Its supply is finite and demand is universal, making it inherently resistant to the destabilizing forces that affect other assets. When other markets falter, gold's intrinsic value becomes a beacon of stability, a rare asset that performs not by chance but by design. Finally, the ability to time exposure to volatility is crucial. Billionaires do not treat gold as a static holding. They view it as a dynamic instrument within a broader risk management framework. They monitor market indicators, geopolitical developments, and macroeconomic trends to determine when to accumulate, when to adjust, and when to leverage gold holdings against other positions. In an era where volatility is the defining characteristic of global markets, gold is not just insurance. It is a strategic tool that allows wealth to survive, adapt, and even thrive amid chaos. Billionaires are leveraging insider-level economic insights in ways that most investors can barely imagine, and gold has become a central instrument in translating that knowledge into tangible security. These individuals operate at a level where access to real-time data, advanced modeling, and private briefings allows them to perceive patterns invisible to the average market participant. They can anticipate policy shifts before they are widely reported, detect supply chain disruptions long before they hit headlines, and understand the subtle cues of inflation, interest rate changes, and currency devaluation in near real time. While ordinary investors react after the news cycle has passed, billionaires act proactively, using gold as both a hedge and a tool to capitalize on insights that few can verify independently. Economic insights at this level are not just about numbers, they are about context and interpretation. A spike in commodity prices is not venalized alongside geopolitical tensions, central bank communications, currency flows, and corporate earnings forecasts. A minor adjustment in interest rates by a central bank in Europe or Asia is interpreted not simply as a financial signal, but as a potential catalyst for market realignments that could ripple globally. Billionaires recognize that these subtleties, when combined, create scenarios where conventional investments may underperform or even incur significant losses. Gold, with its intrinsic and universal value, becomes a mechanism to translate these insights into action. It provides a buffer against systemic shocks that cannot be predicted with certainty, but can be anticipated through careful observation and analysis. Access to privileged economic intelligence also allows these investors to understand the timing of their gold acquisitions with extraordinary precision. They are not buying indiscriminately in response to fear. They are calibrating purchases based on predicted volatility, currency fluctuations, and macroeconomic trends. When a government signals a potential stimulus package, when bond yields are likely to adjust, or when fiscal deficits point to long-term currency weakening, these investors move in a calculated manner. Each purchase is informed by a matrix of data points and projections that ordinary market participants rarely have the resources to analyze. This timing advantage ensures that gold is acquired not at peak panic, but at moments where its value is poised to respond to systemic pressures, maximizing both security and potential upside. Furthermore, billionaires use gold to diversify not only across asset classes, but across the invisible contours of risk that others cannot quantify. Conventional diversification focuses on spreading investments across stocks, bonds, and real estate. But true diversification requires understanding exposure to political, technological, and global economic shocks. By holding gold, they insulate themselves from risks embedded in digital finance systems, supply chain disruptions, currency crises, and geopolitical instability simultaneously. Gold acts as a universal stabilizer because it is not tethered to any single economy, market, or institution. Its value is resilient because it exists outside the conventional systems most vulnerable to sudden failure, making it a uniquely versatile instrument in the billionaire's toolkit. The predictive power of economic insight also extends to anticipating shifts in investor behavior, which can amplify the effectiveness of gold as a hedge. Billionaires can read trends in retail and institutional investor sentiment, gauge when markets are likely to overact, and identify points at which fear will drive collective action. They understand that mass psychology often triggers the very volatility that gold is meant to mitigate, and they position themselves to benefit from it. By moving early, they exploit these behavioral patterns to stabilize their portfolios, while others scramble to respond, turning insight into tangible advantage. Gold in this framework is not simply a passive asset. It is an active instrument in executing strategy at the intersection of foresight and behavioral economics. Global monetary policy is another arena where insider-level insights matter. Changes in central bank strategies, foreign exchange interventions, and sovereign debt management are signals that reverberate through markets in subtle yet powerful ways. Billionaires study these signals continuously, often combining publicly available models to predict the downstream effects on currency values, interest rates, and asset prices. Gold becomes the anchor in these scenarios, a tangible asset that retains purchasing power even as fiat currencies fluctuate under policy pressures. This anticipatory approach allows them to act decisively in the early stages of market shifts, turning potential vulnerability into a source of strength. Access to private briefings and high-level networks further amplifies these advantages. Conversations with policymakers and economic strategists provide context and nuance that raw data cannot capture. Billionaires synthesize these sites with market intelligence to identify risks that are underappreciated by the broader investing public. Gold, as a universally trusted store of value, is the natural vehicle to translate this knowledge into security. It is not simply a defensive play, it is a manifestation of informed foresight, a way to convert sophisticated understanding of complex systems into concrete wealth preservation strategies. Moreover, the interplay of macroeconomic indicators and geopolitical intelligence creates layers of opportunity that are invisible to less informed investors. Understanding how trade imbalances, inflationary trends, or fiscal deficits interact with political instability allows these investors to anticipate crises before they occur. Gold is their lever in this environment, a reliable medium that responds predictably to the very forces that create turbulence in other markets. By aligning acquisition strategies with predictive insights, billionaires convert abstract knowledge into practical, high-impact action, ensuring that their wealth is protected and even positioned to benefit in an environment where uncertainty is the only certainty. Central bank policies are among the most closely watched signals by billionaires when it comes to allocating capital into gold, because the actions of these institutions ripple across the global economy in ways that few other forces can match. In 2026, central banks are navigating uncharted waters, balancing inflation control, economic growth, and financial stability while responding to political pressures and market expectations. Interest rate adjustments, quantitative easing programs, and currency interventions are not just technical maneuvers, they are harbingers of shifts in purchasing power, market confidence, and global capital flows. Billionaires study these moves meticulously, understanding that gold, with its historical stability and intrinsic value, is often the optimal hedge against the systemic risks embedded in monetary policy decisions. Interest rates, for example, are far more than a cost of borrowing. They are signals of the broader economic environment. When central banks lower rates, the value of cash can be eroded as savers earn less and investors chase higher-yielding, riskier assets. Conversely, rate hikes constrain debt-laden economies and suppress growth. Billionaires analyze not only the immediate implications of rate adjustments, but also the long-term impact on currency strength, capital allocation, and market psychology. Gold emerges as a strategic counterbalance because its value tends to rise when confidence in fiat currencies wanes or when interest-bearing assets become less attractive. By monitoring subtle policy shifts and reading between the lines of central bank communications, these investors can position themselves ahead of broader market reactions, turning potential risk into opportunity. Quantitative easing and other liquidity programs further influence the calculus. By injecting vast sums into financial systems, central banks create conditions where traditional assets may inflate artificially, leading to asset bubbles and currency depreciation. Billionaires recognize that while subprimes can temporarily stabilize markets, they often sow the seeds of future volatility. Gold, in this context, it is not just a hedge, it is a form of insurance that preserves wealth regardless of the distortions created by policy interventions. Its value is anchored not to government balance sheets, but to scarcity and global trust, making it uniquely resilient when central bank actions unintentionally destabilize markets or undermine fiat currencies. Currency policy is another critical dimension. Governments and central banks often engage in subtle manipulations of exchange rates to boost exports, control inflation, or manage debt. While these maneuvers are designed to achieve domestic objectives, their effects are global, influencing international trade, capital flows, and investment decisions. Billionaires, with access to advanced economic modeling and insider-level insights, anticipate how these policies affect not just individual currencies, but the relative value of international portfolios. Gold provides a neutral, universally recognized asset that is unaffected by the specific outcome of currency policies. It allows investors to maintain purchasing power across borders, even when national currencies fluctuate unpredictably, offering both protection and flexibility in a complex global environment. The transparency or lack thereof in central bank communications adds another layer of strategy. Policy statements are carefully worded, often leaving room for interpretation. But experienced investors can read the subtext connecting seemingly isolated statements into a coherent forecast of economic trends. Billionaires use this information to adjust their positions in real time, buying or increasing exposure to gold when they anticipate policy moves that could undermine confidence in other asset classes. This predictive advantage enables them to act decisively while others are still trying to interpret the news. Gold, in this context, becomes a tool not only for preservation but for tactical positioning within a dynamic and often opaque financial system. The interplay between global central banks intensifies the complexity and the opportunity. Policies in one major economy inevitably affect others due to trade interdependence, capital flows, and currency relationships. A stimulus program in one country may trigger currency weakness elsewhere, prompting investors to rebalance their holdings to maintain stability. Billionaires track these interactions meticulously, using gold as a universal hedge that mitigates exposure to cross-border shocks. Unlike equities or bonds, which may be tied to specific national markets, gold responds predictably to systemic stress regardless of origin. Its finite supply and global recognition make it an ideal tool to counteract the cascading effects of interlinked monetary policies. Market psychology also amplifies the influence of central bank actions. Traders and institutions react not only to the policies themselves, but to perceptions of credibility, competence, and commitment. A central bank perceived as overly aggressive can trigger dramatic swings in currency and asset markets. Billionaires, attuned to these nuances, anticipate how markets will respond, timing their gold acquisitions to align when policy decisions are likely to induce volatility. Gold in this scenario serves as both a hedge against uncertainty and a strategic instrument for capitalizing on the predictable reactions of other market participants. Finally, the long-term implications of central bank policy create enduring incentives to hold gold. Even as governments and monetary authorities attempt to stabilize economies through intervention, the cumulative effect of sustained stimulus, debt accumulation, and currency management often undermines long-term confidence in fiat money. Billionaires recognize that in an environment where systemic risks are compounded by repeated policy maneuvers, gold offers not just immediate protection but enduring value. By aligning their portfolios with these insights, they ensure that their wealth remains resilient, benefiting from the predictability of gold's response to policy-induced uncertainty while insulating themselves from the unpredictable consequences of global monetary decision-making. Limited supply and increasing global demand are forces that create a perfect storm for gold, and billionaires in 2026 are capitalizing on this dynamic with precision that few others can match. Unlike paper assets, whose quantities can be expanded or contracted almost at will, gold is finite. Mining yields are constrained by geological realities, extraction costs, and regulatory hurdles, while recycling can only provide a fraction of total demand. At the same time, global appetite for gold continues to rise, driven not just by investors seeking safety but also by central banks expanding reserves, emerging markets building wealth, and technology sectors requiring specialized applications. This imbalance between finite supply and growing demand creates a structural advantage for those positioned early, turning gold into an increasingly strategic and high-leverage asset. Billionaires understand that scarcity magnifies value in a way that ordinary market forces cannot easily disrupt. Even minor disruptions in mining output, transportation, or geopolitical stability in key producing regions can trigger price spikes. They monitor global mining operations, trade policies, and labor conditions to anticipate potential bottlenecks before they affect broader markets. By acquiring gold in advance of these shocks, They not only protect their portfolios but also position themselves to benefit from the inevitable upward pressure on prices. This proactive approach is informed by a combination of data, historical precedent, and an understanding of the psychology that scarcity imposes on markets. When something is perceived as rare, the urgency to acquire it often creates self-reinforcing demand. The interplay between limited supply and rising demand is further amplified by central banks, which have increasingly turned to gold as a reserve asset. Nations with growing economies, particularly in Asia and the Middle East, are diversifying away from traditional reserve currencies, seeking stability and protection against geopolitical and economic uncertainty. This official demand adds a layer of predictability to the market, yet it also tightens the availability of physical gold for private investors. Billionaires, with their access to advanced market intelligence and global networks, are able to anticipate these trends, acquiring gold ahead of surges in official buying that can dramatically shift prices. They understand that when multiple forces, private accumulation, government purchases, and industrial use converge on a limited supply, the resulting market dynamics heavily favor those already holding the asset. Industrial demand, often overlooked by casual observers, plays a subtle but significant role in tightening supply. Technologies such as electronics, aerospace components, and medical devices increasingly rely on gold for its unique properties, including conductivity, corrosion resistance, and biocompatibility. While this sector does not dominate the market, it adds a baseline level of consumption that cannot be ignored. Billionaires account for this steady, non-speculative demand when evaluating the long-term value of their holdings. In a world where supply is relatively fixed, even moderate industrial consumption creates incremental upward pressure on prices, reinforcing the advantage for those positioned early and allowing them to benefit from trends that extend beyond mere investor sentiment. Investor behavior amplifies scarcity's effect further. When markets sense that gold is limited or that acquisition by high net worth individuals is accelerating, psychological factors can drive additional demand. Fear of missing out becomes a tangible market force, triggering a cascade of purchases that pushes prices even higher. Billionaires familiar with these behavioral patterns time their accumulation to exploit this effect, acquiring strategically in anticipation of broader market reactions. They understand that scarcity is not only a physical constraint but also a psychological one. The perception of limited availability can create urgency that magnifies returns for those already holding gold. Global economic uncertainty compounds the impact of limited supply. Currency volatility, inflation fears, geopolitical instability, and financial market fluctuations all converge to make gold increasingly attractive. Unlike equities or bonds, which can lose value rapidly during crises, gold's scarcity ensures that it retains purchasing power. Billionaires analyze these macroeconomic variables continuously, assessing how each factor interacts with supply constraints to create opportunity. When combined with the rising demand from central emerging markets and industry, scarcity becomes a force multiplier, allowing early holders to capture both security and growth potential in an environment where many other assets are vulnerable. Logistics and storage considerations further highlight the strategic nature of gold acquisition. Unlike digital assets or stocks, gold must be physically stored, insured, and sometimes transported under secure conditions. Billionaires approach these challenges as part of their competitive advantage, leveraging private vaults, global networks, and specialized custodial services to manage risk efficiently. By doing so, they not only preserve the intrinsic value of their holdings but also maintain flexibility to act when scarcity-driven market movements occur. Control over physical assets in a constrained supply environment translates into the ability to respond quickly to price spikes, shifts in demand, or emergent opportunities, giving them an edge that is invisible to most investors. Finally, the cumulative effect of limited supply, rising demand, and strategic positioning creates a compounding advantage. Early accumulation by informed investors reinforces scarcity, which in turn drives further demand and amplifies price growth. Billionaires exploit this feedback loop. acquiring gold in measured stages that maximize their exposure while minimizing risk. They do so with a deep understanding of the global forces at play, from mining output and industrial consumption to central bank policies and investor psychology. In 2026, gold is more than a safe haven, it is a scarce, highly coveted, and strategically leveraged asset whose value is magnified by the very forces that make it increasingly difficult for latecomers to acquire significant holdings.